Stocks finished the week to the upside. A lot of the gains coming in the last hour or so of the trading session. Was it enough? Did we get up high enough now to say, okay, full steam ahead into next week? So I'm going to look at the technicals and break that down and see what to expect and what could drive us through and where we can find some opportunity as we kind of get back on that path of double-digit returns for the year, for the calendar year going forward. So let's go ahead and get started. Today is Friday, February the 23rd, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Glad you found us. Keep coming back for more day in and day out. Subscribe to our YouTube channel by clicking that red subscribe button. You can do that right now, right down there below the video. While you're down there, also click that thumbs up icon. That lets me know, number one, that you got some value out of today's video. Also lets me know, number two, you want us to do it again on Monday. So one click, very easy way to give us feedback there. Comment on anything that stands out to you from today's video. What did you learn? What did you get out of it? What value did you find? Scroll all the way down to the bottom and comment on that. Finally, join my daily email list. I send out an email every day in a conjunction with this video. I send you a time-stamped hyperlink summary of everything we talked about. So make sure you're on that list. Again, there's a link down in the description that will take you to that. Follow me on Twitter for more content just like this. In addition to these videos, even if you're not a Twitter person, you can still get more stuff from us there. Again, you can see my handle at the screen at DavidSettle42. Like and retweet tonight's Market Outlook tweets, always pinned at the top of my timeline. Finally, join our Market Outlook community. There's almost 900 of us now. It's on Facebook. The address is at the top. There's also a link in the description below that will take you there so you can join. All right, so let's take a look at the market forecast then with the S&P 500 to kick us off here. You can see the momentum line spiking after spiking to an extreme low point just 2 days ago. Spiked back up because we closed at the high of the day today. Spiked back up to an extreme high point, so 99 there. Now, the extremes on the momentum line are meant to be possible changes in trend. In this case, we already had a bullish posture with that momentum line spiking up. It's a good sign, but it doesn't necessarily say that we're going to change to a bullish posture because we already have one, being up above 50 there. Near-term line came out of the reversal zone after dropping down in the reversal zone. So actually, from a short-term perspective, both of these lines dropped down to what would be a bearish low points, a bearish pattern for both those lines. Market sentiment still dropping, path of least resistance still to the downside. As bullish as today's move was, excuse me, as bullish as today's move was, you notice we were unable to get above these long upper shadows. So that 275 area still acting as a resistance. Now, if we can break through that resistance, great. And again, remember this line I'm going to leave drawn on here. This is the 23%. The average move for when Januaries have a 5% move or higher. The average return for those calendar years, including that January, ends up being a 23% return. So that's what this is here, that line. That's kind of the pace for that kind of return. So, you get back above 275 or 2750, 275 on SPY, and we get back up above the pace to get that kind of return. You see, we got well above that pace early, with the move in January. We pulled back down. We pulled back, not surprisingly, because we were so far above it, we pulled back down below it, and now we're getting right back up to it. So, interestingly enough, we can pull up to 227.75 by the middle of next week and still be on pace for a 20% return, even though we've had that kind of volatility so far this year. So, crazy year to say the least. And again, this was a bearish posture, a bearish pattern on the short-term sentiment. I'm not necessarily sold yet that we are on a new intermediate run here with the intermediate line crossing above 50. Not with that kind of a pattern on the short-term sentiment. Now, if that near-term line gets in the upper reversal zone, great. But you notice it's just above 50. It can produce a bearish near-term high, which would actually be, because that's where the close was here. That's the highest close right there. We already have a higher close. If we can't get above 2750, I keep confusing SPX and SPY. If we can't get above 2750, then that would be a divergence on the near-term line. It would be a bearish high point with the near-term peaking, the blue line here peaking between 50 and 80, and then coming back down. So until we cross that level, I'm not necessarily convinced that we're going to be starting this bullish run quite yet, especially the market sentiment line still pointed lower to the downside. So now my mind can be changed, and what can change my mind from a technical perspective, because you know you have to have evidences to change your expectations, right? You just can't change them willy-nilly. And so the evidence would be, you know, these long upper shadows that act as the tops of those long upper shadows that act as resistance. We'd have to break above those resistance levels. Simple as that. So that's what we're seeing on the S&P 500. Let's take a quick look at the Dow Jones Industrial Average here. And very similar, you know, longer upper shadows. Over here, not quite above it yet either. Short-term sentiment coming off a bearish pattern as well, not quite bullish yet. Intermediate line just crossing above 50. The Nasdaq Composite, which had, you know, the longest upper shadow, you can see the resistance at the top of that 73.38. We're at 73.37, so we're there, but we're not above it yet. So it's something to keep an eye on. And again, market sentiment's already very high here. Remember, we don't expect very much return when you get up above 80, and you can see we got a lot of return there that was quickly wiped out that fast. So we don't typically get much return when you get above 80, so we're not, you know, expecting much of an intermediate run. But the Nasdaq, out of all the major indexes, has the strongest bullish posture with the intermediate line higher than the others. You can see the Russell 2000 kind of in between, and again, not quite up above those long upper shadows yet, with short-term sentiment coming off of bearish patterns and not quite forming the most bullish patterns. And in this case, the near-term line on the Russell hasn't even gotten above 50 like the others have. So you know, we today was bullish, and it was a good bullish close, but not bullish enough to say full steam ahead next week quite yet. All right, so with the close here today at the high of the day, we got above the 50-day moving average. Obviously did not get above the last 2 weeks' high points. Again, that's about where that 2775 level or 2750 level resides. So that's why that would be so bullish if we were to get above that. And that's why it would change my mind that we wouldn't get more of a short-term pullback towards these lows than we've already gotten. And you can see, again, we continue to kind of meander around the 50, and with the gap so big and coming down, that's what you expect. Expect some ups and downs. I'm not expecting a bearish trend anytime soon. You know, and again, the expectation is still bullish, but we're going to, you know, have some volatility around that 50-day moving average more than we ever did in 2017. If you take a look here at the 3 green arrow chart, you can see we're almost at the third green arrow. That's another reason why 2750 is going to act as a resistance level. The MACD and stochastics both have green arrows. They're both above their moving averages that are both rising. So positive. The MACD is still below 0. Stochastics above 50, but the MACD itself is still below 0 because the 8-day is still below the 7-day, and both of them below the 30. That's kind of that next stage. After the price gets above the 8 and the 17, your next stage is for the 8 to get above the 17, and then ultimately the last stage of a bullish trend is for both lines to get above the 30, and of course we're not anywhere close to that quite yet. You can see here how bullish today's move was, and a lot of that is coming at the very, very end of the day. We were trading 272.75 in the last half hour or so. We made a run up, $2 run up to 274.75, getting up towards that 275 area, which is the high of the week here. Let's see, right this week right here, and then of course the high of last week, right around just a little bit above 275. So made a nice good run to kind of get there. We'll see if it's able to break on through to the other side here late next week. And again, that would change expectations and be a lot more bullish. Whereas, you know, now we're kind of hitting resistance of the sideways move. And again, you expect resistance to hold until it doesn't, even on a short-term basis. So you look for a move back down to 271, 270 if this resistance to hold next week. And again, you know, we've had a 23% Fibonacci retracement as of yesterday's close, and that's about all we've gotten after such a bullish rally. So again, you breathe in, you breathe out, and you take deep inhales. You expect, an orderly exhale, and we're not getting that kind of normalized pullback. And if we're not getting that kind of normalized pullback for whatever reason, then, it's, again, shallow exhales after deep inhales typically eventually leads to a deeper exhale, and that's, deeper than what's orderly. So, whether that will happen this time, I don't think that will happen this time. But don't be surprised if we don't hit around this 270 again, if this kind of bullish move to resistance fails. And if we break down to 270, don't think it's the end of the world. We'll just have a lot of support in this area here from old highs and lows and Fibonacci's and things like that. That will hold us up, and of course a much stronger support level at the bottom of those low points from a few weeks ago. You can see the range at 270 is the midpoint. We're getting really close now to start to move this lower. We'll keep it for most of next week. We'll keep it just right here above 282 at 50, and we're not going to move it up anytime soon. But it's kind of interesting to see after such a wide range, and we've got a few weeks here to go, but we're really starting to tighten up the range here. We're going to be moving this down eventually to that high, and then eventually moving this up to, as of right now, that low point. And that's about a 5-point range. And normally that's actually, we've seen that that's about the 4-week range. And the fact that it's so small in comparison to that move shows how big this move was and how big the current range is. And we just happen to be tightening up right smack dab in the middle of it. If you take a look at the range today, we've been tightening up a little bit this week. 3.5 point range, volume at 89 million. Both those numbers well below their averages. Let's see, where's that chart? I need this chart right here. 89 million is well down here. 3.5 point range is also below its average. So very positive. If that's, if we might get we might get like a 4-point move and some decent volume if we were to break above 275, and that would solidify that kind of breakout. If we get above 275 with a 2.5, 3-point move and 100 million shares, don't buy into it. But if we get a decent move, let's say 125 to 150 million shares being traded in a 3 to 4 point range, closer to 4, then that will be a good breakout type move that you would need to get through that kind of resistance area. And then that would solidify it. And now we're moving back up towards 285 and getting back on the pace, from that line that we drew way over here, getting back on the pace of that regular, in this case, a 20% return for the calendar year. Look at the volatility index, and you can see, again, I have to kind of duplicate a couple of these here because we've been tightening up. We did not break out above 20 yet, and we're still kind of below this 17.5 level. So we're kind of tightening. The volatility is kind of tightening up here. So again, break below 15. Good move above 275 in SPY with a break below 15 on the VIX. Great. Good. That would be bull. That would solidify that bullish move. If we hold this resistance and this kind of move makes a run back up towards 20 on volatility and gets back above it, then now we're having more of that near-term pullback that we were expecting during this little run right here that didn't materialize this week. You can see on a relative basis, the volatility index crept back down now into that kind of neutral zone between 90 and 95. Above 95 is bearish, below 90 is bullish. We're right back kind of in that neutral. So we're kind of in that swing area where we can go really one way or the other. Getting back below 90, again, solidifies this bullish breakout next week. But assuming resistance to hold until it doesn't, you would expect this to get back up above 1, and if it does, then we might get that more of that near-term pullback that, like I said before, did not materialize this week as expected. As we transition now to what's driving this price action, just a reminder again, to get more content like this, to follow me on Twitter. Again, there's the address, twitter.com/DavidSettle42. Brandon is also on Twitter at Brandon Van Zee, and of course you can see our markets_scholars account. Make sure you put the underscore in there. That will get you to the right account there. We haven't got that blue check yet. Also, while you're on my account, to make sure that you get the stuff that we put out, like and retweet, especially the market outlook tweet that's always pinned to the top, tonight's market outlook tweet. Like and retweet that. That will make sure that Twitter knows that you like to engage with our content, that you want more of it. And it will. The benefit I get out of that is Twitter will promote it to all my followers to make sure that they're seeing it too, because it is an engaging piece. So we've kind of dipped back down. Let's see, we got close to our record. Our record's 143 likes. The goal is to try to get above 150. So let's see if we can't do that here over the weekend. All right, transitioning into what's driving. There's not a whole lot of economic calendar. A lot of Fed speak. There's actually some interesting QE speak out there today. But outside of that, not a whole lot that's driving the price action. You can see for the week that was this week, the market bounced up, but a lot of the gains for the market came today. We were down 1% for the week as of yesterday. And then we bounced up today, and you can see the dollar remains strong. So the dollar had a good, strong week today. Crude oil bounced back up with some inventory data yesterday, continuing its highs. Let's take a quick look at the crude oil chart. Here we go. So you can see after dipping below this Bollinger Band, getting from the high upper band, dipping below the lower, not bouncing off the lower band and getting back up again, coming down, pushing below the lower band. So you say, okay, well, now we're going to hit that middle line and continue to trend lower. No, so far as of right now, breaking up through the middle band, and with the potential now to head towards that upper band, which would be these old highs just above 66. So positive development there for crude oil. When you look at the dollar index, again bouncing off of what would be a double low point, hitting some resistance at that old high point. Starting to really, these Bollinger Band width really coming down, not as low as it's been in the past, but where it's, sparked a run before. In fact, last time it sparked this kind of run, it was lower, and then we had that big move to the downside there, coming off a much tighter range. So not nearly as tight yet, but tightening the dollar index. And again, the idea, the expectation here is more of a bearish move. You take a look at a weekly chart, you can see we're below the 50-day moving average. We're below the 200-day moving average. So we're kind of tightening below. We had moved away from the 50. We're kind of tightening as the 50 catches up. And again, with the trend as it is, you would expect that we'd break out of that tightening to the downside. A little bit of a divergence forming here, lower lows with higher lows. Of course, that would mean we'd have to break up above the 50-day moving average, get back up to 95, which would be the target high of that divergence. And of course, breaking above 95 would lead to a much stronger dollar move. And again, that we don't expect, you don't expect counter trend moves until you get it, right? In this case, you expect it to continue the trend. So you expect after we tighten up here, a little bit of a pennant formation on the weekly chart, that you'd break out, move to the downside. And of course, that would coincide with a subsequent move, a bullish move on crude oil. You can see getting back above the 50-day moving average, riding still a bullish trend. And you can see gold, with the dollar kind of bouncing up this week, pulling back towards its 50-day moving average, but still sitting above it. So again, you expect that trend to continue to rise until it doesn't. So, always expect moves in the direction of the trend. Always expect resistance and support to hold until it doesn't. And then you can say, okay, now let's start looking for how to trade that counter move. Those are really the two biggest outliers. With the dollar being as strong, crude oil was the outlier to the upside for the week, up 3.25%. Gold down 1.5%. Now just looking at just what happened here today, you can see stocks rising, large caps outpacing small caps on this move. You can see that treasuries outpaced high yield, so it wasn't full-on risk appetite. Gold did outpace, crude oil killed gold. The gold is the only asset class that was down on this particular list, and you can see emerging markets outpaced developed markets. So there was some risk appetite there, but not full-on broad-based, just because large caps continue to lead their way higher. In fact, you can kind of see small caps was leading for most of the week until today. Small caps jumped up, pulled back, and never was able to recover nearly as much. as the large cap index. Now we look at the sectors and how they performed first on the week. That was, and a lot of it was consumer staples lagging. You can see utilities and real estate were also lagging for the week until yesterday, and a little bit of a bounce here yesterday, and then of course today really taking off. Utilities up 2.6%, real estate up 1.5%. Technology is that momentum sector still rallying. Energy stocks also rallying with the increase in crude oil. Let me pull back a little bit to the 4-week move here, and you can see that technology being that momentum sector. Look at utilities over the last 4 weeks. So utilities has been, during the pullback in February and now the subsequent bounce, utilities has held its value better. 1%. Now real estate's down 5%, but interestingly see how utilities has held that value pretty well. And remember, during the same 4-week period, bonds, here at the blue line, bonds are down 4.5%. Long-term bonds, according to TLT, is down 4.5%. So utilities, during a period where bonds have been, struggling, and you can see stocks all struggling too, all down 4%. Stocks and bonds falling, but down 4.5%. Utilities, with yields rising, utilities rising too. So that's not typical. Usually utilities will rise along with bonds when yields are falling. Now, really quick, some perspective on this, on that utility move here. You can see how up until that middle of February, it's had a really poor 3-month run. And a lot of it's coming right there from December the 15th when yields took off. But from that point, when stocks really started to drop there up until now, it's one of the best performing asset classes out there. And real estate, struggling. It's housing is kind of struggling a little bit from this idea of rising costs. Higher of borrowing, making the affordability really low right now for housing. And so unless wages starts to creep up, you got higher yields, higher mortgage rates, higher prices, and so unless wages start to come up along with it, it's going to make that housing sector really struggle a little bit. You see why it's holding back, but you can also see consumer staples not doing so well either during this run, this drop and subsequent bounce. There's your momentum area, and of course energy stocks. You can see why they've bounced so much in the last couple of days, because they've had, they suffered the most during the pullback, and then they just didn't bounce when everything else did. So for our trade idea of the day, I want to take a look at another stock that kind of fits that weak dollar mode. Monsanto is a stock that's typically bullish when the dollar is more bearish. We looked at FCX before, and this is in that materials sector, but not necessarily in the same industry, of course. And you can see today, 3 green arrows today, boom, 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 on an upward trend, so you don't need the volume spike to justify. And you also see, too, that you've got these long upper shadows all along the way during this pullback. And then most of them on up days, mind you. And then you can also see, too, that we closed above. Like today's close got above all of these highs. So essentially a good support bounce off of what would be a higher low point. I mean, the last time we got 3 green arrows was right there. And so this would obviously be a higher low than that one. So the trend is higher. And there's some resistance here at 122.50 that we'll have to break through. So it might be a situation where if you enter into an equity position, a long position, that we start off small here, half a position potentially, with the other half coming after you break through to the other side. Obviously support would be below this 120 level, where you got the the 3 green arrows, because you got the 1 red arrow there. So here was kind of a 3 green arrow bounce too, but you didn't get the MACD really until right now. So this is the full-on official 3 green arrow move, and then of course that 1 red arrow here gives us a support level right around 120. So you put your stop order down below that, account for the volatility of this stock compared relative to, like, say, SPY. You don't want to put like a broad, like a standard, 2 or 3% below support. because not every stock behaves the same. Some stocks are more volatile than others, so some stocks need more room to work with than others before breaking below support. Fake outs occur all the time because, for an example, everybody else sees those same low points at 120. I mean, it's not just something that you see. If you see it on the chart, a lot of other people see the same thing. So a lot of other people will be looking at a support level in that area too, with stop orders down there too. So if you put your stop order too tight within a tradable range for the stock, given its volatility, then you'll see it break through 120, clear out all those stop orders, and then bounce right back up without necessarily changing the trend, and maybe even do that on the intraday basis. So that's why you don't want to put it at a set percentage, for every single stock. Account for some stocks that just happen to be more volatile than others. But remember, another way to trade this too, if you don't want to buy the stock or keep the equity position small, is you can sell puts, you can sell put verticals. Keep in mind on a stock like this, its spreads are relatively large, so it's going to make that a little cost prohibitive to get filled in on that. Not a whole lot of trading going on. You can see it's got higher volatility levels, but you can see not a whole lot of contracts trading on this particular stock. So that will make, again, entering a long position because you got 3 green arrows on a higher low point, the trend, going with that bearish dollar. Just make sure you start off a little bit smaller until you break through this 122.5 level. Once you do get that, then you can go in for a full position. You can do it on the breakout because you're still relatively close to where that 120 support is. You can also wait for a return move back down to what would be a new support level. Make sure it holds, and you would expect it to until it doesn't. And then after it bounces off of that, enter in on a new set of 3 green arrows, another part of your position, say the other half of your position. So to summarize, the market's continued its near-term run without that much of a pullback this week. And we finished the week about as bullish as we could, right at the high of the week. But we are still at the highs of a lot of long upper shadows on the S&P, the NASDAQ, Russell, whatever the index. So there's a lot of resistance still here that we have to kind of break through to make sure that we can sustain that. So don't be surprised if we don't hit that resistance and pull back a little bit more. That was the expectation for this week. We didn't get much of a pullback this week. So we can see it might pull back down to that 270 area in the S&P 500. But if it breaks, and if it breaks with a pretty decent move and volatility drops, then we know that break's got a good chance of holding, and we can continue higher. This intermediate run that's just starting can persist for a while. And seeing the dollar not really taking hold of a new bullish move and hitting its own resistance with its long-term trend still in a downward position still gives us opportunities to make kind of weak dollar trades, including what we looked at today. So that being said, have a great evening. Thank you for watching. Remember to like, subscribe, and comment down below. Follow me on Twitter. Join the Market Outlook community on Facebook. Keep this conversation going. That being said, again, I hope you all have a great one. Thanks, as always, for the engagements and the likes. We really appreciate those, and we'll see you all on Monday.